Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
Man, Hari, this is fourth episode in a row you've been wearing that shirt.
I know. I just sit here waiting for Becco to come, so that we could record. I literally do nothing else. So, but I do love White Castle. White Castle, if you want to sponsor us, you are welcome to do that. You can
That's where I was going.
You can even pay me in burgers if you want.
Yeah. By the way, is there any White Castle in Houston?
No. I think they're all in the Northeast. So please don't ship them to me in payment. You can get them at the grocery store.
Frozen ones, yeah?
Yeah, exactly.
Yeah. All right. In this second episode of Medifast, we will talk about the interesting part, the financials, the management, the valuation. So if you like to have access to our checklist, again, we go through a checklist to analyze every company that we go through. We go through a checklist. So if you like access to that, email us at info@valueinvestor.org, as well as the drill, guys. Slack channel, checklist, and if you want us to analyze a company, again, info@valueinvestor.org. All right, Hari.
So let's get to it. Actually, I'll give you the disclaimer real quick. This is the Value Investor TV podcast. We're a podcast that helps you understand the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation, so please consult with the appropriate advisor before making any investment decisions. Okay, so we had talked about Medifast as a company that had a strong brand and some switching costs that kind of kept them afloat. They had a durable competitive advantage and a long runway for growth based on the fact that they're in the weight loss management thing, which is a double-edged sword because that could create some scrutiny from groups, and we've said that they kind of compete with Herbalife, who was kind of targeted for a while by some value investors who thought they were a fraud, but we kind of went through some of the reasons why they were different, and so if you'd like to learn more about it, make sure you listen to the first part of this episode before you go into it, before listening to this one. But okay, so Becca, we were actually done with the business part of it, but we wanted to talk about the financials. So does Medifast have is it able to translate its moat into a high return on capital?
All right, so if I look at return on equity, and again, I want to preface this, every time we talk about this, we want to use sort of multi-year return on equity. We don't want to just use 1 year snapshot because it could just spike up or spike down, right? So we want to use multi-year average. And I think this is a case in point. 2019, their return on equity jumped up to 74%. And then before that, 2018, it jumped up to 51%. Before that, it was hovering around 25%. Same thing for return on capital employed. So last year, 2019, it went up to 80%. The year before that, 64%. The year before that, it was hovering around 35%. So I would say, this company is growing, right? The reason why these numbers are going up is because the top line and the bottom line, they're also growing relative to the equity base and the asset base. So it's a thriving business. So I would say, on average, you're looking at return on equity of about 30-35% and growing. So really solid business from that standpoint.
Okay. Which is very, very high. I mean, anything above 15% is considered very good. So, and this company's equity base basically hasn't changed. Their income has grown, and which is a very positive sign, right? That's where, we ask the question about, does it need reinvestment for it to grow its business? And we're actually seeing the opposite of that, right? There's no reinvestment, but the business is growing. So that is clearly a very solid, sign for us. And okay, so looking at the cash and debt level, does Medifast have any problems with debt, and does it have enough cash to maintain its business?
Yeah, so this is where I get really excited because this company, again, every company that comes across our desk for the last, I don't know, many, many episodes, have always had this problem with debt, right? I mean, this has been a plague that is just devastating many companies, and it's just that debt level just makes it uninvestable in many cases, right?
Yep.
In this case, you're seeing a company with zero interest bearing debt. The only thing they have is like lease obligations and stuff like that. But so no debt, which is great. And on top of that, they have a so this is as of June 30th, 2020, cash equivalent and investment securities of $145 million.
So
So that's on their balance sheet. We're talking about a business that's generating about $700 million in top line, and then the bottom line is about $70 million.
well, and I think the important thing is that $70 million is basically all free, right? It's all available to its owners, right? For share buybacks, dividends. There's not none of that money has to actually be invested again to keep the business going. So that's a
Yep.
very good, kind of metric. Okay,
Yep.
looking at that, no debt, plenty of cash, and generates solid, free cash flow. Okay, so we kind of covered the financials very clean on that from that aspect. So let's talk a little bit about management and what is management incentive structure. And is the company run by somebody we can kind of that is properly incentivized to keep all of these great metrics going?
hmm So if we look at let me see here. I'm looking on my notes to figure out the incentive here. Where is it? Here we go. Okay. So performance-based awards are based on three criteria: revenue, operating income, and lastly, number of active earning coaches. So again, revenue, operating income, and third one is number of active earning coaches. And what that is people who are this is what we talked about in the first episode, right? These guys are who used to be consumers of their product and now they loved it so much they are running their own business, selling Medifast as an independent contractor. They're not part of the company. They're not employed. They don't, they're not on the payroll. They're just out there leveraging their infrastructure, Medifast's infrastructure, to set up their own business as coaches, lifestyle coaches, selling their product. Clearly, if I look at that, their incentive structure is aligned for growth, right? Revenue, number of active earning coaches, operating income, right? If that is the target, they're growing for growth. So that's how they're incentivized right now. I think what I would love to see is maybe a fourth metric to make sure that the debt level is reasonable. Maybe a one on capital efficiency, so things like return on capital employed. I think I would have loved to see that.
Mm-hmm.
But at this point, with such a clean balance sheet, I think focusing on growth could be the right way to go.
Okay. Can you tell us a little bit about the management's honesty? Do you see any red flags there? Excuse me.
Bless you. I don't see any red flags. One thing that I did notice is that a lot of the executives are based in Utah,
Okay.
and they all went to Brigham Young University. And one thing I know about Brigham Young, there are a lot of Mormons there, and Mormons tend to be very, very ethical, at least from my experience. So,
Yeah. I mean, I don't disagree with you on that.
yeah.
Hard to measure that, but I would not be, they are ethical. So
Yeah.
Okay, let's look at the valuation then. Tell us how you what assumptions you're making and what value you want to assign to this business.
All right, let's take a look. So we're starting off with initial free cash flow of $75 million. And just for context, their top line for the last 3 years have grown at 37% compounded annual growth rate. For the last 10 years, they've grown at 15%. That's just top line. When you look at EPS, which is even more crazy, EPS for the last 3 years, they've grown at 63%. 63% for the last 3 years. For the last 10 years, they've grown at 23%. So, I mean, wow, West. I mean, they're just growing like crazy. And same thing for free cash flow. They've been growing last 3 years about 47%, last 10 years about 18%. So, again, in this exercise, we want to be conservative. We don't want to be too liberal with our estimation here. So, excuse me, starting with initial free cash flow of $75 million, I assess that the growth rate for the first 3 years is going to be about 20%. And then this is, again, kind of a, conservative estimate. And then 4 to 6 years, another 20%. And then 7 to 10 years at 10%. And again, we use discount of 10% all throughout the 10 years. And if you do that, intrinsic value comes down to about $100. Right now, it's trading at $177. And again, I would say that growth rate here that I'm putting in here is pretty conservative, because if you look at the most recent quarter, they blew the quarter out of the water. I mean, their performance, the COVID quarters, right? Their revenue went up 17%. Their net income grew. It grew at about 3%, and their active coaches grew at 20%. They're growing despite COVID.
Yeah, I mean, I think there's probably a lot of people who are focusing on their health and stuff like that right now. So I think it's probably a reasonable thing with people having more time and more stuck at home, that some businesses will thrive. Like we've seen streaming services and things that focus on tech have kind of thrived during COVID. So this is not one I would expect, but it's not surprising, I guess.
Mm-hmm.
So it sounds like it's a good business to keep on the list. And if we had been savvy earlier in the year, you could have probably gotten this one at a discount.
Yeah, absolutely. I mean, let's just take a look at the stock price for a second. Yeah, back when when things were really gloom in March, it went down to $53. I mean, that's like right on intrinsic value. I would have loved to pick that up at $53. I mean, I think this is a really a fantastic business, clean balance sheet, run by really good guys from what I can see. High returns on capital. This one is a keeper in my opinion.
Yep. Okay. So, well, I think the only problem that I think we would have right now is that, you can't really, you got to keep this list and you got to keep checking on it every so often, because that's really the only way to, keep an up-to-date list. And then you have to measure which ones are cheap, which ones are the ones that you would want to hold on when they go on sale. And so, unlike Darden, this has a growth component to it that we would want to be mindful of, right? Because they can basically grow without any investment. So, it's a very, very, it's the kind of business that you would dream of, right? This is the one that you want, is something that doesn't need to reinvest to keep growing. So,
yeah. And so, I mean, I think that adds another complexity to the valuation here, in that this could be sort of a Charlie Munger play, in that you could pay a little bit of premium,
right,
to buy a great business that is growing, right?
Yep.
You could play it that way. I think for my taste, maybe a little too high. Again, the intrinsic value is $100. Maybe the estimation, the assumptions that I put in the calculator is a little bit too aggressive. I would have loved it to perhaps picked it up at, maybe like closer to 100. I think I would have been comfortable at intrinsic value.
Yeah.
But again, I think this one's a keeper, something to keep my eyes on.
Yeah, and I mean, when I bought it, this was in 2011. I think I bought it and sold it in like 2016. Revenue was kind of flat. Earnings had not really budged much. And I was hoping for this big bump, looking at their profitability and other things. That didn't come, until 2017, 2018. So, I missed that boat. I sold it at around $30 a share, 32, something like that. So I got a double out of it, which was nice. But for a business, and I saw all of the aspects that we've mentioned here, right? This was a company that had a very high, profitable, business, didn't require a lot of investment. But part of their problem was that the growth was just not what I thought it could be, right? And after 4 years of waiting, I was kind of frustrated with it because I just wasn't happy with how they were doing things. And in 2017, the things that they had talked about for 4 years finally started becoming a reality, and so I missed out. I don't have anything other to say other than I missed out on them.
Mm-hmm. I would perhaps venture to guess that it really started to pick up with a lot of social media influencer who are sort of out there pushing the product.
Yeah.
Right. I mean, that sort of coincides with the timeline there with 16, 17, 18. Sort of just jumped. You
Yep.
got a lot of Instagram, influencers selling this product, becoming coaches, and having their own set of businesses.
Right.
So I think this trend will only continue. We got like social influencers that are pushing products. This direct sales methodology,
Yep.
I think, is a very powerful one because it doesn't require a lot of investment from a company standpoint.
Right. Okay.
So,
Well, if you have any questions about Medifast or have any comments, you can message us on our Slack channel. You can also message us at info@valueinvestor.org. That is a great place for you to get a hold of us, ask us any questions, do anything else, that we have going on, and find out more about what we're doing. I just want to give everyone an update for those of you who use the website too. We have our valueinvestor.org, and that is a database of stocks. Becco and I refer to it a lot during the podcast. It is free to use. We would love to hear your feedback on that on the website. Please check it out. Send us an email if you have any questions or features that you want us to add. Becco and I are constantly updating it. We had some issues in the last few weeks with the site was not updating. There was a bug that caused it to not pull in the data from our data feed, but that's been fixed, and we're making some updates there. So please use it. Please tell your friends about it. We're trying to get that service up and running. It is fast and it is designed for quick rundown of companies, and you can get almost 30 years of history for every business that's on there. So if the business existed there. So please take a look at it, and we'd love to hear from you about it.
awesome. Well, thanks everyone for listening. I hope you enjoy this podcast on Medifast. I certainly did. It was an exciting company.
Yep.
If you guys, reach out to us, and thanks again for listening. I'll talk to you guys in the next episode.
All right. We'll see y'all later.